Well, guys, this may not be too obvious to you, but millions of Americans are quietly running out of money right now. And it's not happening because of one dramatic event. There's no single moment, no one thing that you can point to and say, well, that's what broke the budget. It's a slow squeeze from every direction, all at the same time. Higher grocery bills, higher insurance premiums, higher housing costs, bigger debts, higher utility bills, and now energy prices are creeping back up because of everything happening in the Middle East. And guys, the deal is, at some point, something has got to give. And today, I want to show you exactly what's happening, why so many people are feeling this financial pressure even when the headlines say the economy looks fine, and most importantly, what you can be doing right now to make sure that your household doesn't become part of this statistic, etc. So guys, in this video, I'll explain all of that, and all I ask is that you stay with me all the way to the end, because the last segment of this video is the practical playbook, what to actually do right now with your own money in this environment. Alright, so let's not waste any time, let's jump right into it. Alright, so let's start by looking at where millions of Americans already were financially before the latest round of price increases right as they hit. Because this context is really important and it doesn't get talked about enough. Credit card balances in this country are at a historically high level right now. The average American is carrying about $6,500 in credit card debt at an interest rate between 20 to 23%. Nearly 50% of all Americans are carrying a balance month to month, meaning they're not actually paying it off, they're just rolling it forward and getting charged that brutal interest rate every single month. Guys, auto loans have gotten completely out of hand. A record 23% of new car purchases in America are now being financed for 7 years or longer, which means that people are stretching payments on depreciating assets over nearly a decade just to make the monthly number work. And even student loan payments have returned for most borrowers. And on top of all of that, insurance premiums across the board, home, auto, health, have all been steadily rising for several years now. So guys, think about this picture for a second. Millions of families are making payments to a credit card company or a car lender or a student loan servicer or a mortgage company and an insurance company, all before they buy a single bag of their groceries. And then we wonder why people feel financially destroyed. The savings right now has dropped to around 4% nationally, which means that the average household is only saving 4 cents out of every dollar that they bring home. And a lot of people aren't even hitting that. Emergency funds have been shrinking for the last 2 years running, and more people are turning to credit cards not for luxuries, but just to pay their regular monthly bills. So, with that being said, I want to talk to you about inflation and energy, because these are the two accelerants that are pouring fuel on a financial situation that was already stressed for a lot of families. So, inflation cooled down significantly from the 9.1% peak that we saw in 2022, but here's what people keep getting wrong about that. Lower inflation doesn't mean that the prices went down. It means that the prices were rising a little more slowly. And now inflation is rising again, coming in at 4.2% just in May. And that's the highest it's been in the last 3 years. Prices at the grocery store never came back down from where they went during the last spike. They stayed elevated, and now they're going higher again on top of that. The energy price is critical to understand because energy isn't just what you pay at the gas pump. Energy is what it costs to move food from where it's grown or manufactured to the grocery store. Energy is what powers the truck that delivers everything to your neighborhood. Energy is what you pay to heat or cool your home. It touches everything in your budget simultaneously. Now, the good news is, and this is genuinely good news, it's that as of right now, the Strait of Hormuz is officially open. Commercial ships and oil tankers have resumed traveling through the region and following a memorandum of understanding between the US and Iran, even though technically they're at war still. That is a real development in the right direction, but the situation still remains fragile. Shipping volumes haven't returned to pre-conflict levels, and energy markets are still watching every development closely. If that strait stays open and oil supply normalizes, we should see some relief at the pump. But if it closes again, everything gets more expensive very fast. Now guys, if this video is giving you any value so far, please show some love by smashing that like button, leaving a comment down below, and subscribing. Your support genuinely helps this channel grow, so please guys, show some love, smash that like button, leave a comment down below, and subscribe. Alright, now let's move on to the next segment. Okay, so now I would like to address something that I think causes a lot of confusion and honestly a lot of frustration for a lot of people, and that is the disconnect between the stock market and what's actually happening in real American households. Guys, the S&P 500 is up over 9% year to date. By stock market standards, that's pretty good. And President Trump has pointed to market performance as a sign of economic confidence and strength. But here's what I need you to understand. The stock market is not the economy, and the economy is not your household budget. These are three separate things, and they can all be moving in completely different directions all at the same time. You can have a strong stock market while families are getting squeezed on groceries, insurance, gas, and debt payments. You can have low unemployment at 4.3% on paper, while the jobs that are being created are concentrated in sectors that actually don't pay particularly well. You can have a GDP growing while wages aren't keeping up with what things actually cost. The companies that make up the S&P 500 are mostly large corporations with strong pricing power, and a lot of them are doing well precisely because they're raising their prices, which is a part of the reason why your grocery bill is higher. Their gains are not your gains. So when you look at your monthly budget and it doesn't feel like a 9% market year, that's not a personal failure. That's the reality of how these two worlds can operate independently of each other. Alright, so here's the thing that I want you to really understand about the financial pressure that the people are feeling right now. None of these individual problems by themselves would be enough to break most families. Higher grocery bills? That's manageable. Higher insurance alone? Most people would figure it out. Higher car payments alone? Yeah, it's annoying, but it's survivable. But when all of these pressures hit simultaneously, higher groceries, higher insurance, higher housing costs, higher debts, higher energy costs, slowing down a job market, declining your savings, and rising credit card balances, that entire combination is what creates what I call a full financial squeeze. And the timing is particularly brutal right now because this squeeze is happening right as people were starting to feel like maybe things were going to get a little bit better. Rates had started to come down a little bit just a few months ago. Inflation seemed to be cooling, but there was a cautious optimism at the start of this year. And then the Iran conflict hit and energy prices spiked, inflation reversed course and started climbing again, the Fed froze rates, and the whole picture changed in a matter of weeks. The job market is also quietly shifting in ways that matters for average workers as well. Hiring has slowed down noticeably. Companies are becoming more selective. AI is beginning to automate tasks that used to require human workers, and the jobs being added are increasingly concentrated in sectors like healthcare and government rather than higher paying private sector roles. None of this is catastrophic by itself, but you stack it all up together and you start to understand why so many people who are doing everything right still feel like they are behind. Alright, so I know I spoke a lot there, but here's what you actually came for. And this is the most important part of this video. You cannot control inflation, guys. You cannot control what the Fed does. You cannot control energy prices or what happens in the Middle East or what decisions get made in Washington. But you can absolutely control what happens inside of your own four walls. And that is where your focus needs to go right now. First, know exactly where every single dollar is going out of your bank. No guessing, no estimating, no ballpark figures. Pull up your last 30 days of your bank statements and your credit card statements and go through it line by line. A budget is not a restriction, okay? It is the thing that shows you exactly where you have power to make changes. Second, attack bad debt aggressively. Every dollar of interest that you're going to pay towards a credit card company, especially at 22%, is money that is actively working against your financial future. Every single dollar of interest that you can eliminate is essentially giving yourself a raise. Third, look for ways to grow your income, not just cutting expenses because you can only do that so much. There is a ceiling, but on the opposite side, there's no ceiling to how much you can earn. A new skill, a certification, a side hustle, a higher paying role, whatever that path looks like for your situation, income growth is the lever that changes the game in ways that cutting alone never can. Fourth, protect and build your emergency fund, even if it's just a little bit every single pay period, because unexpected expenses are not a question of if, but when. Fifth, avoid taking on new debt right now, especially for cars or any depreciating assets. And sixth, keep investing consistently, all right? Even in small amounts, even during scary economic headlines, because dollar cost averaging over time has proven to be more effective than any attempt at perfect timing. The people who come out ahead over the next 10 years won't necessarily be the ones who made the most money. They'll be the ones who manage the money that they made the best. That is the whole game in a nutshell, guys. I want to thank you for watching this video all the way through. Please subscribe so you don't miss any of the new videos that I put out every other day. And please drop a comment down below. Tell me what's causing you the most financial pressure right now. I genuinely read every single comment, and I know our community is always looking forward to seeing what other people are dealing with so that maybe they can learn from it as well. Thank you guys for watching, and I'll see you guys in the next video.